Hi, everyone. Welcome to our Harvesting Revenue Week 1 course. The goal is, now that we are in Thanksgiving and fall, right, we get the turtlenecks out. The goal is that we can start to look at where we are in our business in 2021 and where we are going and hope to go in 2022. But a big part of that is really taking a look at our revenue. I know we've talked about it before, but the things that have changed from pre-COVID to post-COVID. And we hear more and more about inflation, but what has inflation really done to our business? So there's a lot we can learn by digging into our revenue, into our trends. And the hope is that these 2 weeks will kind of get you in a better understanding of the things that we really should be paying attention to as we go into next year. Because the more that we can understand about what has happened this year compared to 19, the more we can actually help and make sure that we're on a good path moving forward, even if there is inflation, right? Because there's nothing we can do about that, but we just need to make sure that we're aware of it, we're prepared for it. And a big part of that is our revenue. So we're going to touch a little bit on the cost side, but most of this is geared towards revenue and really making sure we understand exactly what's happening in our business. So as we go into Thanksgiving, obviously time to give thanks, but we really want to use this time to look backwards at 2021. So you hear a lot of times about people talk about Black Friday. Well, in the retail world, that's a time that they finally get to a point where they're making profits, right? They're going into the holiday season, they're selling a lot, and it's time for them to really look and know, okay, we covered our expenses. The rest of this is just going to be our profits. Well, same could be true for our business, especially if you're in hospitality. Chances are December is a good month. You know, catering events, hopefully, maybe to-goes, maybe you do, Thanksgiving meals, but usually a pretty solid month for us. So that means as we go into December, we really want to look at where we are year to date, because if we are in a decent position now, hopefully it's even better by the end of the year, but being aware of it will really make sure that we are on top of it and all of those tax planning things and other things that we're not going to get into today, but this exercise is very important for all of those reasons. So we want to look especially at our revenue because there's a lot that's changed in our revenue. So most years it would be like, well, sales are up and that is what it is. But this year there's a lot of things that have contributed to our revenue just being different than prior year. We may have our we raised prices. Maybe we raised prices a couple of times, 2 times 2021, once in 2020, maybe 4 or 5 times. It all depends. I've seen, all over the map. We also may see a change in our customer behavior, right? Maybe our catering isn't fully backed. Maybe our customers really aren't sitting in and dining in our restaurant as much as they were, but our to-go is double, triple what it was. Maybe we have fewer competitors. I've seen that a lot, that, we're just slammed when we're open because we're the only spot in town for breakfast, where before there were 5 or 6 people in town for breakfast. So that may be contributing to it. And then when online delivery platforms, right, that really hasn't gone away. People are still ordering to go using Uber Eats and DoorDash and all those others. There's more online platforms. So all of these reasons make our focus on revenue so important this year, because inherently we have a new business model that looks different than 2019. Even if our dollars are the same, chances are, as we dig into our revenue, it's inherently different. So being aware of that is incredibly important. So what are the 3 steps to understanding our revenue? Well, the first thing is really digging in a little bit to our revenue. What is the revenue by category? Can we tell our revenue by customer or customer type or tickets? Things like that, other information that would tell us a little more about who's coming in to our restaurant. The other one is really reviewing the impact of our revenue for an increase in price. So if we increased 5% of our price on our menu item, what does that do to our revenue expectation? That's important, because if we just look dollars to dollars and we say, sales are up, well, are they up by more than 5%? Have we factored in what our new baseline number would be with a rise in prices? The next is to revise our target to make sure that we have a new baseline factored in for our team as well, right? Because if we bonus our managers, or we're all looking at the same revenue target and we all have in our head, if we have a more than a $20,000 week, we're in good shape. Well, maybe that should be $22,000 now because we raised our prices. And the raise in prices is really to offset increased costs. So that 20,000 that we all knew was the break even, or what we just have to do, may not be the break even anymore because our costs have gone up. So really, have we adjusted our thinking to be aware of the rise on both sides, right? Okay, so the first part is reviewing our revenue by category and customer. So what I would recommend is if you were to take your weekly snapshot, and most of this can be pulled from your point of sale system or your bookkeeping software, but probably point of sale is the best place to go. So what we would look at is how can we break down our revenue? So can we break it out in-person dining? Can we tell online ordering, and can we tell catering? In most cases, even if on the accounting side you keep all of this in, food and alcohol, your point of sale should be able to give us a little more. If they're not able to break it out on the sales report, sometimes you can on the collections report, because chances are if your online ordering goes through your point of sale, it will show you how much is collected from the online ordering. So if it's still food is food, maybe go to your tender amounts, and you should be able to see your Uber Eats, Grubhub, and all of that. So that's really what we want here, because it's very important that we see how much of our sales are online ordering. Now, again, it is what it is. This isn't going to be about, reducing that or getting rid of that, but it's really more of an awareness, because we want to see where our revenue growth is coming from to make sure that we understand it and we plan for it. So again, if I were looking here, my in-person dining was 23,000 this week, the same week of the prior year. Again, that's why point of sale is great, because you can just run different date ranges, was 18,000. Now, if I were looking at this, I would know, well, I was probably still in a little bit of a COVID there. Things were kind of winding down. If anyone remembers, October, November of last year were not very, very good, because COVID was sort of hitting again. But in 2019, I had 21,000. My online ordering, again, pre-COVID, online ordering was a fraction of what it is now. So that is important to see that, my online ordering is now 14,000. And even though my in-person has come back, my online really hasn't gone down, right? That still is what it is. But in 19, it was 4,000, because that was brand new, and it just wasn't really something a lot of people were doing. Catering, I'm at 8,000 now, was at 6,000 last year, and then 12,500 in 2019. So really what this would tell me, if I were looking at my restaurant, would be my in-person dining has gone up, but my big question here is that due in part to a price increase? So the best way I'll show you the math on that in a little bit. Basically, if it is, we would want to take our 2019 number and multiply it by the percentage of the increase that we've done. So if we've done a 5% increase, it would be 21,000 times 1.05, and that would give us our new amount. So if we did that, it's probably about 22,000 at an adjusted price number, which would mean my real growth is about $1,000. So 1,000 is just due to the price increase. Another 1,000 is due to the actual growth in my in-person dining. My online ordering, the big question here is, if I've grown my online ordering sales by $10,000, 19 to 2021, really knowing that 2020 was just what it was, then am I covering all of my cost on that? Because if it costs me 20% of every dollar I sell in those platforms, am I covering the 20% by my prices being different? Now, I really here don't care between the difference in person and online. That's why we're not doing food, alcohol. This is just revenue categories. So I'm not really concerned there, but I am concerned to make sure that my price difference between my online and my in-person covers the cost. So if I only increase my online prices by 10%, but I know that it costs me 20% through those platforms, then I'm actually losing money the more I sell here, right? But if I know that I've covered my cost by having a different price structure on the online third-party delivery, then I could sell it all day long and I don't care. So the big thing here is, so many times we're afraid to increase our prices on these platforms. We're afraid people just won't pay it. But if we're losing money because it costs us 20%, then we're just eroding our margins in that area. So if it costs us 20%, then we probably want to really make sure that we have increased the prices by 20%. Now, pre-COVID, they wouldn't allow it. That really was not allowed. But post-COVID, I think they're more aware of the fact that it costs you guys a lot of money to sell on these platforms. So being aware of this, looking into this, making sure that we're covering our costs, because we don't want to already be starting off with online costing us money, right? Because we know food costs are going up, we know labor is going up, so that's just going to erode our margin. So, but if it's a break even and we know that we've increased our price by 20%, then it's great. It is what it is. People order there, they're going to pay more, but it's also going to cost us a little more, or they can come in person and not pay the same price, right? And the final one is catering, right? Here we would know catering really probably hasn't returned, but when it does return, are we prepared to also have that same price increase? Because remember, food costs have gone up everywhere. So if we're serving 25 in these big platters, have we also adjusted those prices to make sure that when we do, we have our same margins? So if I have 12.5 there, maybe I need to do a 5% increase on my catering as well to make sure that my menu prices on catering are still adjusted and still have those good margins, even though I'm not doing it as much. Because even though in November we haven't, maybe December we'll have more, parties have come back, maybe people are out more. We don't know, but we want to make sure that if we did all this work to revise our menu for COVID, did we also do that to our catering now that it is starting to come back a little bit, right? Okay. On the flip side, if we're looking at customer behavior, a best way to do it to take out all of the impact of price increases would just be to look for other things that show us volume. So the best thing to do, and most POS systems give us lots of data on this, would be either number of customers or number of tickets. Now, the only thing to watch here is depending on how your online ordering is done, it may be the case that those don't ring in number of customers and just do one. So sometimes I've found that tickets is the best way to go because tickets are 1 for 1. So if it's an online order, it's 1. And if it's in person, it's 1. Whereas customers are great information, but a lot of times the online ordering is 1 and it's really for 6. So that may be skewing the numbers. So digging in here and really getting in the habit of looking here can really show us, do we have growth or is this increase in revenue just a rise in prices? In this case, what we would see is we do have a little bit of growth, right? Not as much as we see in raw dollars, because again, we did increase our prices, but we do have a little bit of growth here from 19. And here, again, we would just want to dig in to make sure these are accurate numbers with the way online ordering and catering are rung into our system. Okay, so again, with the impact of prices, it may make sense to build a target also with your team based on number of customers, right? Forgetting the revenue, at least for a little bit, but let's set a target of having, 1,250 people come in next week or 850 tickets. And then it doesn't really matter what we did to our prices. We're still going to just try to get more customers in the door than we had last week. Okay, so if we wanted to then go back and set our targets and use our price increase, which is very important for your team to see as well, because a lot of times, especially if you have your experienced team, they're just used to a set revenue target every week, right? Your management, they've been looking at these numbers probably for a few years, and they just know what's the number that they want to beat or what really equates to a good week or a bad week. They're probably not thinking about price increase as changing that number. But if we were to look at that, if I were to do the same exercise, taking my 2019, 2020 numbers, what is my new expectation? So if I know that I did a 5% increase in my food price, then if I'm basing my target on 2019, my revised target, instead of 34,000, is going to be 35,700. So that's really my adjusted price. So that's the same number, just in the new reality of inflation. Alcohol, if I didn't do a price increase, is just going to be the same. So that would be something else we could do for our team to say, well, hey, 34,000, used to be our target for a good week. It's really 35,700, but because we raised our prices, that's just the adjusted amount. So anything above 35,700 is still our really good week, but we need to get to 35,700 to make sure that we're the same. And that's where that customer tickets can come in, really showing them, yes, it was a good week, even though the number is drastically bigger. Maybe you did a 10% price increase, but we really had, 30 more tickets than we did in 2019. So we're good. Okay, so this is a good exercise for your team to do or just get used to doing. So we make sure that we're all speaking the same language in terms of setting targets for a good week. Now, the next piece of this would be to build our weekly targets down the line, right? So we have our adjusted revenue because we know that the prices went up. So instead of a $34,000 week, my target is a $35,700 week. And then my alcohol stayed the same, but I probably also want to revise my food costs. Now, again, if I did a price increase recently, my cost of goods may look like they're going down. That's just our price increase impacting that percentage as well. But we still probably want to look at, what is our cost of goods running right now? And it may be up from prior years, and that's okay. So in this case, I'm going to make sure that I've covered that in my COGS and my labor, assuming both are 30%. And then my operating expense of $10,000, which means my target for the week is a $9,880 net income. So that's a really good week, right? And that's something that I can definitely share with my team and set a target across the board. Now, anyone who's getting incredibly frustrated with inflation, I know it has been a long and hard road. I've had clients who've told me this year has actually been harder than last year. So if you feel overwhelmed and exhausted, it's not you, it's the situation, because you do have costs that are constantly going up and you feel like you're constantly raising prices to your customers to cover the costs and you don't know if it's enough and you don't know if they're frustrated. It's just a lot, right? But the one silver lining, and I'm not saying inflation is fun for anyone, but the one silver lining of inflation is that your fixed costs are actually more affordable, right? The one silver lining of the fact that you've had to raise prices and you have all these rising, ingredient price and all of that is that your rent as a percentage is probably less, right? It's staying the same. It's the same amount, only in some ways, the dollar is less valuable. It costs more dollars than it did a year ago. But on the flip side, if we've had set fixed costs of $10,000, that $10,000 is more affordable because it stayed the same. It didn't go up. So variable versus fixed actually works in our favor in this regard. Whereas in COVID times when we didn't have sales, fixed was the biggest Achilles heel. It was the hardest thing to cover, was the fact that it cost me $10,000 whether I'm bringing in any revenue or not. Well, now it's the opposite, right? Things are going up constantly and our customers are willing to pay it because everything is going up and that same 10,000 has stayed the same. So the one silver lining in inflation is that 10,000 feels less because everything is going up. So I encourage you to do this weekly exercise because as much as it is frustrating, the people that I've seen who just embrace it and say, well, if I got to pay my dishwasher $22 an hour, then pizza's now, $5 more, whatever it is. If we embrace it, we can still get the bottom line to where we want to be. Because in any world, right, universal rule for running a solid business is I want my net income to be at least 10%. Right? At least just to cover cash flow and surprises and all of that. So it doesn't matter if inflation or no inflation or costs are going up or costs are going down. I need this business to work at 10% bottom line. And the only silver lining of that is that it's going to be easier to get to 10% bottom line with my fixed costs because things went up. So there's good and bad in every environment, but I encourage you because the people who are able to embrace this are able to just find the model that works. And in some ways, it's the same as COVID. We have to find the model that gets us to 10% because if we don't, it hurts us, right? The rest of the world is the rest of the world and there's nothing we can do about it, but we have to get our bottom line to 10%. But I promise you, if you are able to do this revenue detailed work, you're able to see the revenue that's hurting you, the revenue that has some growth, and able to find the way to get to 10%. And that's really what we want to do now so that we're set up for next year. So with that being said, next week, we're going to take all the work that we did here and build our forecast with revenue targets to get us to the end of the year. So what do we think December looks like? Have we dug into our catering? Like I said before, did we increase our catering by the same percent that we did our in-person dining to make sure that when catering comes back, we don't have terrible margins there, right? We're still getting our good margins. So all of that work is going to be next week, but this week we want to do these two very important schedules. The first one, or you can do this in one Excel, one page, is revenue weekly by category. So digging into your point of sale, what is your in-person dining, say for the most current week compared to 2020 and 2019? If you don't have the information there, go into an old point of sale system. If you don't have it there, try to do some digging in your books, whatever you can to get this information. This is incredibly valuable. The other one is our online ordering. If we don't have it in our point of sale, go to the online ordering systems. We need to have this data because it will give us a good path forward for next year. Catering, same thing. If we don't have it in our point of sale, go to wherever we have it because we need to find some benchmark that compares the last 3 years, last 2 years, so we have a good starting point. Then we want to review our item pricing, right? Take your burger or whatever your common dish is, your brisket, whatever it is, and look at your item price in 19 compared to 2021. What is the percent that it went up? Did it go up 5%? Did it go up 10%? And with that percent, now we're going to be able to set our new revenue target. So again, same work that we did above. If we take our target, what is our target for 2021? Probably based on 19 number because 2020 was a little crazy, unless you live in Florida, which 2020 was a great year. But otherwise, November 2020 wasn't great for many people, but you take that with a grain of salt. So your target's either based on 19 or 20. And what does that look like with that increase in price? So with the 5% adjusted, what is my new revenue target? And broken out by food and alcohol. So that's your two homework pieces that will flow very well into next week, which will be building our 12-week forecast with our revenue targets. So please feel free to reach out if you do have any questions. If you're feeling lost or it's just like way too much math, please reach out. There's a place on our website you can get a free consultation, and we'll be happy to help walk you through it and make sure you kind of have this set up going into next week's course. So thank you again, and I hope everyone has a great week.